Hello everyone, today March 5th, we're going to take a few minutes to discuss markets, the economy, the outlook for rate cuts, and what this all means for investors. So without further ado, turning to equity markets, it has been quite a start to the year for US stocks, which managed to break out above their previous high, which was dating back to early 2022, thanks in part to the good performance of some of its big technology stocks. But even if you exclude the 7 biggest stocks, technology stocks in the US, the stock market would still be in record territory, which goes to show that the rally has been rather broad-based and definitely better in the US than elsewhere in the world, where most indices still remain below their previous high, although across the board, the last few months have been very positive, so a lot of optimism in the equity market. And there's also growing optimism on the part of consumers, with sentiment indices increasingly more, rebounding more rapidly, which is probably in part a reflection of the fact that the stock market is doing so well, but also more fundamentally speaking, there are usually 2 key drivers of consumer sentiment: inflation and employment. And with the unemployment rate still pretty low and stable, and inflation not yet at the 2% target, but much more comfortable around 3%, these have been very welcome news for consumers. So if it's going so well, you might wonder, well, why central banks would cut their policy rate this year? And indeed, markets have revised their expectation in this regard, whereas they used to expect 5 to 6 rate cuts. Now it's only 3 rate cuts that are priced in for 2024, which is in line with the Fed's own median projection and also in line with what actually happened in the mid-1990s, which is a period that many people are using as a comparable to what we may be experiencing going forward. And indeed, back then, the Fed, after having hiked rates substantially, had actually cut rates only 3 times, and importantly, all of that without going through a recession. And there are definitely similarities with today in the mid-1990s, notably with what's happening on the technology front. But we must bear in mind that the monetary tightening we've just experienced is far more important than the one we had seen in the mid-1990s, and perhaps even more importantly, even if on the surface the picture is a rather good one on the economic front, with, for instance, GDP growth at 3%, which is even higher than the potential of the US economy. If you look at the picture, the broader picture, you still see some yellow flags showing up, and sometimes even literally contradictory or even mixed signals with, for instance, GDI, which is literally the twin brother of GDP, that is currently telling a much different story. In fact, it's the biggest divergence between these 2 measures that we have ever recorded. So without getting too technical here, I think the key takeaway from this is that we should probably not take for granted this resiliency. There's still some elements of fragility popping up, especially knowing that historically, it's often at turning points in the business cycle that we have seen these 2 measures diverge. And back in the mid-1990s, as you can see here, even though we refer to this period as being a soft landing, the US economy had barely lost any altitude back then, with growth trending steadily around 4%. All right, now 3 takeaways to sum this all up. The story of the last few months is one of optimism that rings across, whether it's from investors, consumers, or central bankers that are hoping to repeat their success of the mid-1990s. And to be clear, there are definitely encouraging signs that we're seeing on the economic front. But again, when you take the global picture, some yellow flags, some confusion as well, so a lot of uncertainty. And against this backdrop, as investors, and that's always the case, but especially nowadays, our best ally is diversification. And what I mean by that is that it's probably not the best time to deviate too much from your longer-term asset allocation target weights, although at the margin, in the short run, would still advocate a slightly more conservative stance, given that the optimistic thesis behind the equity rally is somewhat fragile. That's it for today. Wishing you all a great spring, and we'll talk again in June.